Imagine investing just 2000 rupees every month and one day seeing it grow into lakhs, even crores. That's the power of SIP investing. In the next few minutes, I'll explain how SIP works, why it's powerful, and how you can choose the right one confidently. And if you want to understand money and investing in simple language, welcome to Money Mastery. Most people think saving money is enough, but it actually isn't. Most Indians keep their savings in bank accounts, fixed deposits, recurring deposits, but here's the issue. Savings account interest is usually 3 to 4%. Meanwhile, inflation in India averages around 6%. So, if you keep money only in the bank, your money is slowly losing value every year. That's why investing becomes important. And one of the simplest investing methods for beginners in India is SIP. SIP simply means investing a fixed amount regularly in a mutual fund. Think of it like a monthly subscription for investing. Instead of investing a big amount at once, you invest small amounts every month. For example, 500 rupees per month, 2000 rupees per month, 5000 rupees per month. The money automatically gets invested into a mutual fund. Over time, your investment grows with the market. That's why SIP is very popular among young professionals, salaried employees, first-time investors, and today you can start SIP through apps like Grow, Zerodha Coin, ET Money, or Paytm Money. Let's understand SIP with a simple example. Suppose you invest 5000 rupees every month in an SIP. After 1 year, total invested amount becomes 60,000 rupees. Now imagine the mutual fund gives an average return of 12% per year. Over time, your investment starts compounding. After 10 years, total invested would be 6 lakh rupees. Value could grow to roughly 11 to 12 lakh rupees. After 20 years, total invested would be 12 lakh rupees. Value could reach around 45 to 50 lakh rupees. This growth happens because of compounding. The real magic of SIP is time. Starting early can make a massive difference. For example, person A starts investing at age 25, 5000 rupees per month, invests for 30 years. Total invested would be 18 lakh rupees. Final value could reach around 1.5 crores. Now person B starts at age 35, same SIP amount, invests for 20 years. Final value may be around 50 to 60 lakh rupees. Same investment. But starting 10 years earlier created a huge difference. That's why experienced investors always say, start early, stay consistent. Another reason SIP works well is something called rupee cost averaging. Markets go up and down all the time. When the market falls, your SIP buys more units. When the market rises, your SIP buys fewer units. Over time, this balances your average buying price, which means you don't need to worry about timing the market perfectly. This is why SIP works really well for busy salaried people. Now, the big question. How do you choose the right SIP? Here are 3 simple tips beginners should follow. Tip 1. Choose the right type of fund. For long-term investing, beginners often start with index funds, large cap funds, and flexi cap funds. These are usually more stable than small cap funds. Tip 2. Check fund history. Look at 5-year performance, fund manager record, and expense ratio. Apps like Grow and Zerodha Coin show all this data easily. Tip 3. Invest for the long term. SIP works best when you stay invested for 7-10 years or more. Stopping SIP after 1 year defeats the purpose. It's like going to the gym for 1 week and expecting results. Many beginners make a few common SIP mistakes. Mistake 1. Stopping SIP when markets fall. Ironically, that's actually when SIP becomes more powerful. Mistake 2. Expecting quick profits. SIP is long-term wealth building, not a lottery ticket. Mistake 3. Choosing funds only based on last year's returns. Always look at long-term performance. So, to summarize, SIP helps you invest small amounts, benefit from compounding, and build wealth gradually. And the best part? You can start with just 500 rupees per month. If you want to learn more about investing, personal finance, and building wealth step by step, this channel, Money Mastery, is exactly for that. In the upcoming videos, we'll also talk about an important question many beginners have: mutual funds versus stocks, which one is actually better for Indian investors? We'll break down the key differences between mutual funds and stocks, which option is safer for beginners, and how Indians can choose the right investment strategy. So make sure you subscribe to Money Mastery and tell me in the comments, what SIP amount would you start with today?